Hey guys, welcome back to the Results Junkies podcast. We've got 3 topics that we can digest today that are all pretty meaningful. I don't think we're going to get through all 3, but just to team up at a high level, we're going to talk a little bit more about how some of the biggest companies, Microsoft, Google, Amazon, are playing kingmaker, and how a recent article in The Information sort of ties in some ways that founders might be able to leverage this. Paul, you shared 2 pieces that we want to try and get to as well. You shared a tweet about Hopin, which was a company that raised a whole bunch of cash, and how they're returning cash to shareholders, which has both positives and negatives for us to discuss. And then finally, Google is sort of dealing with this same issue of paying for news and blocking it from some folks on their site. Something that's been happening overseas and in Canada, but really hadn't crept into the U.S. until this started happening in California pretty recently. A lot to cover there. How are you doing today, man?
I'm good. My voice sounds horrible, but I feel great. It's just been a busy week here at the house, and here in Virginia, it's probably the same near your house. The pollen is insane.
Oh, my car. Yeah, my black car is actually yellow. So
my white car is yellow.
Yeah, everything is yellow. Everything is awesome.
Yeah, no, but life's good. Cranking on all fronts. But how about you? I see you at home. This is so crazy.
I am, yeah. And as I'm sitting here thinking too, I made a mistake because I got more memes from Instagram, and they're not of you crawling underneath your trailer, but they're great. So he was nice enough to provide them to me, and I didn't upload them, so I'll have to do that next week. So My apologies. I'll have more fun.
Oh no! You won't be able to roast me for no reason today. Got it.
I'll come up with a reason. That won't be an issue. It won't be. There'll be something somewhere. So, just a little bit of housekeeping. Show at resultsjunkies.com is how you find us. He is at Paul Singh on all those social media channels. I am at Pizza in Motion, and it sure looks like from your background that you're home as well.
Yeah, speaking of backgrounds, I am starting to get like a weird man crush on your background. It's like I kind of need to redo my office. Like, do I do Lego F1 cars? And I actually want to get one of those Smurl counters for some of the beacon stuff. I got to do all this stuff. So
yeah. I mean, not that the pictures of the family aren't great, but I got some cool stuff hanging out in the background there. I got a few more planes I haven't put together amongst all the junk that's out that way. But yeah, and I will say for folks who maybe missed last week, I did put up a tweet about the open table discussion that we had, and that seems to be a very spicy topic. And I don't want to say I'm glad to see it per se, but I want to make sure that you and I weren't overplaying the importance of that story. But it's been picked up by a handful of people to say, wow, this is a stunningly, crappy privacy decision that they've made. So,
yeah. OpenTable is one of those rare companies that affects more of the real world than most companies. Like when we talk about AI right now, it doesn't affect anything but, frankly, a bunch of executives and super nerds. But with OpenTable, look, everybody's got to eat. And, somewhere buried in those anonymous reviews, obviously are some trolls, I'm sure. But there also were some people that probably needed to stay anonymous for some reason. And now they've been exposed. And that's, I don't know. It's just when you change the rule book retroactively, that's a problem. Which, by the way, we're going to talk a little bit about here in the context of one of those articles we're going to talk about today.
Yeah, we are. We absolutely are. But let's start with this article from The Information. For folks that don't know The Information, it's a paywall news source. I recently signed up for it after hearing from a number of folks that I respect that they like some of the articles there, and so this first one is that, and you can only read the first couple paragraphs on it if you're not a subscriber. So apologies for that, but I think what they cover really well is this concept of AI agents. And so we've got I'll tee up the bad example and the good example, and then I want to hear your thoughts on it. So the bad example is the one that you used earlier about how in Superhuman, you've got this prompt at the top that says, hey, do you want me to write an email for you? And then on the good side, you've got this Superhuman feature that's summarizing an email thread for you and reminding you of everything that's in there. And so those are two different levels of value. And so like one of the thing that the article notes is this notion of creating an agent. So sorry, let me just clarify, not to get wordy, but when we think about ChatGPT is, essentially performing a simple function. You're asking it a question, it's giving you an answer. The agent is stringing together functions. And so one of the functions the article represents, and I might get this wrong, is like a customer that ships durable goods, finds an order that hasn't been fulfilled for a customer. It logs the invoice. It prints the sell ticket so the order can get fulfilled, and then it bills the customer. It has 3 or 4 different steps that it can do because it kludges together a bunch of different pieces. So I'll shut up for a second and say with those pieces that are out there, I want to hear your thoughts first on how you feel about this concept of AI agents.
Well, okay, so just to reiterate kind of what you said, what we talked about at the beginning, like in terms of, or in the pre-show, for me personally, in my day-to-day professional life, it's a ton of email, it's a ton of Slack and messaging and, and then video chats and stuff like that. And increasingly, I see AI prompts everywhere. Like I use Superhuman for email.
Yeah.
Maybe I'm posting something on LinkedIn, stuff like that. So for me, the real utility of AI in the past 6 months for me has been helping me summarize large amounts of information that might be coming in. So for example, one of my favorite features of Superhuman, the email client, is that it summarizes the email for me. So, like I know we're supposed to say we read every email, but the fact is, like, if I'm getting 1,000 emails a day, that summary really helps me understand, is this really for me? Or is this actually, am I on the CC line and I just need to be updated, right?
Right.
Where AI has not proven very useful to me is anywhere it wants to do something for me. So, you go to LinkedIn and the prompt says, type in an idea and let AI make it for you. It's like, whoa, I don't know. I don't like that, or, even an email, it'll say, and I think in Superhuman now you can write the basics of your email and then have it use AI to like write it for you. And for me, that still has an ick factor to it because the cost of a mistake is much higher than the utility it provides me. So here's an example. Founder sends me a term sheet. Well, I'm not I actually kind of like the, Rob, right? Like it's not, there have been times where I'm like, hey man, let's have Rob look at this term sheet. and absolutely, I want him to look at it before we do the deal. But now AI gives me the ability to just kind of have the, give it to ChatGPT and say, give me the high level of this term sheet. And now the cost of a mistake there is still relatively low because I don't have to, I'm not doing the deal at that point. I just want to know what so like Rob's a bad example because he's on payroll, right? But like if I was using an outsourced attorney charging me $500,000 an hour,
right?
So anyway, the summarization part of AI, I think has been really good for me, but anywhere where it proposes to do something for me, it gives me the ick factor because the cost of a mistake or a hallucination in the output is much higher than the utility it provides me. And I kind of need to know, like, if a mistake does happen, I need to know who to be able to go after. Like, I'm throwing I don't know if Rob listens to this podcast. Let's just throw Rob under the bus here because he's not able to defend himself. If you and I do a deal and Rob clears the term sheet and then there's a mistake, well, now not only do we have the ability to say, Rob, what the hell? Sorry, Rob, I know you're really good at what you do. But also, Rob's carrying insurance. I can, if I really have to, I can go get it, get compensation for it.
Yeah.
I can't do that with AI. And, that's part of the reason why I don't think, that's why well, you know where I'm going with this, right? Like I can't.
Well, you said something pre-show. You can't, and you were leading there with a lawyer. I feel in the other piece you said too, is you can't fire an AI.
Bingo.
Accountability all that stuff comes back to accountability.
Right. So like, even when I think about the context of Strata, let's just use that, or the, I can see utility with AI that helps our team be more efficient.
Right.
Like summarize large, updates coming from the carrier, like that sort of stuff. But where I kind of have to draw the line is anywhere where we're like allowing the AI to actually respond to a customer or to a payer or to a partner or to another team member. Like that's, it's the stakes are too high for that. And I don't have any recourse. I'm pretty sure I just saw in my own business insurance stuff. So not Strata, but my own business insurance update, the premium just reset. There was an additional set of clauses in the errors and omissions insurance that now actually specifically excludes any sort of AI usage.
Oh, okay. Yeah, it makes sense. Yeah.
Right. Because they're insuring me and my team from mistakes, but they're not going to take on I can't say, oops, I used ChatGPT, made a mistake here. Can we please, file a claim? That they've excluded themselves from that now.
Well, and I think that goes to this point that the models aren't efficient enough yet to be relied upon without some level of human intervention.
That's correct. And I've been wrong plenty of times before, so I'll just say that's correct. But I can't see a future where responsibility fully shifts to the AI model.
I wouldn't disagree with you, but let's use the lawyer example for a second, and then I want to give you my opinion on this stuff too. You talk about Rob being held accountable. So Rob ultimately needs to be held accountable, but I think you could train the model to say, "Hey, Rob, we've reviewed the mechanics lien language in this lease, and we find it to be more restrictive than the last 45 leases we've read. You should spend time reading these languages. You should look for the commas and the periods." And so I do see that level of single prompt usage of AI improving as the model gets more.
Yeah, that's fair. Yeah,
information.
But in that example, you're still using Rob's name.
Correct.
Now you're
right.
In that example, you're encouraging Rob. Poor Rob. Yeah. But you're encouraging Rob to use tools like this to maybe catch these mistakes a little bit better and compare against the other 45 deals that you just talked about. But you're still using his name. So if
but we're increasing his productivity.
Yes, exactly.
And that goes back to what we talked about.
I can get behind.
That we could talk about last week. So now let's pivot to this model here with agents and where I think this can be transformative for a couple of reasons. One is on the founder side and one is on the consumer side. So on the consumer side, if you're talking about looping together these things, like we've talked about this, like Microsoft and Google and these folks, they have tremendous fortress balance sheets, but they can't acquire companies. And so like, what do they do with cash? Or they can't acquire big companies. So they can build stuff on their own. So if we talk about these agents that can link these things together, you'd say, well, a typical salesperson can only field so many calls in a day. A typical inside salesperson can only field so many calls in a day. A typical order fulfillment person can only fill so many times a day. And so like you could buy each of them a widget that would save them some time and make them more productive. What they're talking about with agents is, okay, now the agent is going to take a piece that helps the outside salesperson, the inside salesperson, and the order fulfillment person and lump them all into one service as an example. And so the benefit there is to say like, well, okay, well now if I make let's say I'm really good at welding and I can make a bunch of cool stuff. Well, maybe I just need a little bit of time for outside sales and inside sales and order fulfillment because the agent is now going to do all the things behind all of those things. So just like the agents are helping coders much more in the beginning, which the article talks about, coders are getting the most benefit out of AI now, but entrepreneurs should be able to use tools like these to do a number of functions in a business. And so what I see here potentially for founders, like an ecosystem that could happen, which I think brings great returns to founders, but not necessarily to investors, is that you build an agent that uses compute. You have to buy the compute from somebody else, obviously, but you built an agent that's smart enough to track outside sales leads, move them into inside sales leads, follow up with the client to get the order done, send out the purchase order, send out the invoice, collect payment, and fulfill the order. And if it can do all those things and you're really popular and you're getting lots of customers, the Microsofts, Googles of the world could buy you at a much earlier stage in the fundraising environment. And then they could say, well, we know we've got cheaper compute costs because we bought all these, whatever, H100s from NVIDIA or whatever the version 2 of the H100 is going to be. And we're going to buy that agent early. It's going to be a much cheaper purchase price. So it probably doesn't come up on the radar of antitrust. And then we're going to plug that agent into Microsoft Teams or some other, Google Suite product, Google Workforce or whatever. And we're going to charge them an extra 15 or 20 bucks a month. And the compute for us is, 60% cheaper than the kid that, built this, great new product. And so they can take the same company and they can increase the margins by a significant sum. And so it makes sense to overpay to take somebody out of the market early and fold that product in as a tool that they could build some sort of a subscriber base off of as an AI agent.
My short response, and then I'll give you a complete one, but the short response is yeah, yes. I mean, look, with antitrust scrutiny and stuff like that slowing down any big acquisitions, it's not like the buyers are going to just they're not going to fire their entire corp dev teams. They're going to push them down the stack to something earlier because they got to put the money to work. It's not like you can just undo this. I mean, you can, but the repercussions are not good for anybody. So the summary is, I think you're going to see M&A move to the earlier stage, and where it's going to be kind of a mess is that, there's going to be the scenarios where they buy a fast-growing early stage company, for 10x earnings or 10x multiples or whatever. It'll look like a big number because it is. But there's also going to be those flameouts where you're going to start to see acqui-hires as well. So corp dev, I think from the few quick conversations I've had with my friends in the corporate development world, the sort of the behind the scenes has been hey, we're busier than ever because they are going earlier stage. On that topic though, one of the ideas I think you're sort of alluding to that I think is particularly interesting is, and I don't know if you would say it this way, but this is one of the ideas that came to my head when you were talking about this, is that one of the bigger opportunities for, entrepreneurs that are looking for ways to make some money, but also potentially be on this acquisition radar. And let's just use B2B sales as an example.
Sure. Yeah.
Is to create little utilities like this, but price them on the upper end of the personal expense card. So what I mean is so I remember one of the earliest companies I invested in was a company called Tout. Founder's name was TK. I met him on Hacker News of all places 15, 16 years ago. And, the company went on to get acquired by Marketo and stuff like that. But, what was interesting is in the early days, and maybe my memory's shot. So TK, if you're listening to this, not my fault. But the thing is,
definitely your fault. Yeah.
One of the things I remember though is that when he was pricing the Tout product in the early days, he didn't know what the right number was, but I distinctly remember a time when he would ask prospects what the largest charge they could do on their company card was without their boss's approval, and magically that became the price.
Yeah.
And so, even in the context of Strata, by the way, I'm seeing this now. For example, doctors and assistants have to write notes after they meet a patient. This is not exclusive to PT and OT, but whatever. And so there's been this push for better documentation, and there's been an explosion of little side projects that are, $20 a month, $30 a month, $10 a month, where it's hey, drop in your clinical notes here and AI will expand them out for you. Then you can cut and paste it back into your EMR. It's happening. But the pricing that they're using is really smart. They're going after the individual clinics, and so here's the example, practice owners know that that's kind of still a risky thing because, there's licensing involved and stuff like that, right? But these companies, these little side projects, they're exclusive. They're explicitly avoiding the practice owners and targeting the clinicians that work there.
Right.
And I see the ads for it all the time. It'll say it's so smart. The ads will be things like stop documenting after hours or stop, get your family time back.
Right.
They're
Right.
clearly not marketing to the practice owner. They're marketing to the people and trying to get them to use their personal cards on it. It's just super smart. And I think there's an
Yeah.
opportunity there for entrepreneurs.
Yeah. Yeah.
And that could put you on that path to what you're talking about, which is an earlier exit. Could be a smaller company like Strata. It could be a larger company. I don't know, like Marketo, so, but
I think there's something to this concept of an early exit, that was, I wouldn't say downplayed, but I would say it wasn't something that was terribly popular, in the past, call it decade to 15 years. It was all about building really big companies to scale. And this concept of, well, maybe I am just going to raise a friends and family or take some money in my 401k or whatever and build a company and then scale it for a year or two and sell it, can still be a great return for the founder because, along the way, they didn't have to hire, a few hundred employees, scale up, and the whole time probably taking a salary that's, below market, the whole bit, and try to accelerate this whole cycle. I want to pivot us to this Hopin tweet. And so for folks who don't know, at Paul Services, I will put this in the show notes. Hopin was an event management platform. I don't even think they're in that business anymore. And I'm bringing this full circle for you just because it's a funny little circle of life moment for us here. Anyway, the tweet goes on to talk about how even though they raised $1 billion, that they ultimately ended up returning over half of that to investors late last year when it was clear the company wasn't going to be able to succeed as a going concern. Well, I looked through some other articles, by the way, because one of the lead investors on Hopin was Altimeter, which is run by Brad Gerstner. But what was interesting about this was that they actually got acquired by a company. It looks like they got acquired by a company called Ring Central, which I've used their product before. They're a competitor to like Teams and Zoom and stuff like that. But what's interesting is the investors got equity in Nuco after Hopin was acquired. And do you know what product they pivoted to work on after this acquisition?
No.
They pivoted to a video streaming platform called StreamYard.
What? No way.
So
I didn't know that.
Literally what we're recording on is reported as the thing that Ring Central pivoted into after it acquired Hopin. So there's your circle.
Sorry, I just want to make sure I understand. So are you saying that Ring Central owns StreamYard?
Hopin. Yes. Seems like it. Yes.
Wow. What a small world. That's wild.
Yeah. So,
well, okay. Well, that's okay. Add that to the trivia list because I had no idea.
Right. So
I think it's super classy though to have given the money back. But we'll get to that when you're ready.
No, I think that's exactly what I was gonna say. Is like so talk to this like at least from the notes that I can see. To be clear, this company raised a seed, an A, a B, and a C, A, B, and C, A, B, C, and D round. Boy, my alphabet is hard today. And from the reports, it seems like anybody who was part of the Series B or later got some piece of this $500 million. And so there's your tee up for how you feel about that.
Well, okay. So first of all, high level, at a high level, one of the reasons I like this particular story to talk about is because it gives people sort of an inside baseball view of what really happens. Because a lot of times this stuff just gets buried away behind NDAs and private M&A and stuff like that. In this case, there was enough players involved that there had to be filings done, and those filings are public and all that. So I love that. So a couple things here. The first is on the one hand, I can say, yeah, it's super classy to have returned that money. But on the flip side, having been on some of these kinds of deals in the past, I would say that it was probably also encouraged to do this in exchange for, maybe an approval to let the sale happen or for the pivot to happen. So in other words, it was probably like the concession that the founder or the owner or the founders had to make. The return of the money was a concession the founders had to make if they wanted to do something that wasn't, palatable by the investors. That's probably, if I had to bet from the outside, the most likely reason this happened. Um, let me pause there. Does that kind of make sense? Do you disagree?
Yeah.
Or?
No, I don't disagree. I think we're going to talk about the rest of the equity stack here at some point. But I say I definitely agree with what you said so far. That and I would say the other clarifying thing is we don't really know what the split was here. I mean, my guess would be that the folks in the most recent round that Altimeter led probably got more of the funding than maybe some of the previous rounds. But in those instances also as well, I mean, Altimeter was probably taking a bigger haircut than anybody else anyway, because the valuation at that point had grown so big. So it does make some sense that they would get a bigger piece than maybe the B, who at whatever price the B is getting their return, they're probably not losing as much money as Altimeter did in terms of valuation.
Well, those later stage deals usually look so different than early stage deals, and you have liquidation preferences and all sorts of, things like that. I think the next piece of this deal that seems to be getting a lot of scrutiny is the founders or what the founder took off the table during one of those previous rounds. And I don't know the exact. So what they say in here is that the founder took 195 million off the table. I don't think it actually explains whether that was all in one chunk in one of those rounds or if it was spread out through the rounds. But for the time being, let's just talk about that. Good for them. Good for them for taking that. Like, if you look at this from the founder's perspective, good for them. You take a little bit of risk off the table. In exchange, they probably sold a little bit more of their own personal equity to the investors. Good for them. On the investor side, it's part of the game, so you can't really like second guess it. That's part of the reason why I bet you no investor has gone public and said, "Hey, what the hell? Where's that 195?" Is because the reputational risk of that would destroy deal flow. So the investors, even if they are unhappy, they're never going to say anything publicly about it. And then there's going to be the employee base, the people that either had stock options or had exercised stock options. And this is the uncomfortable part of the whole thing. Like, if we want to look at it from a moral and ethical viewpoint, I guess you could make the argument that it would have been morally right or morally less worse to use some of that $195 million or whatever to make your employees whole in some way. But the other side of that coin is that, like, look, they got compensated. They got what they contractually had signed up for. And while it is awful that their options probably got washed out to nothing, that was a risk they assumed. And frankly, they didn't have any other real risk that they assumed as well. So the uncomfortable part of this, and tell me if you disagree, but the uncomfortable part about entrepreneurship and capitalism is that risk and reward are correlated. Right? So you want a larger reward, then you got to be able to take on more risk or show that you are taking on more risk. And, particularly for, later stage employees, it's hard to kind of feel bad because it's like, you didn't start the company. You didn't take any risk in those early days. You didn't do all those things. Now, again, I'm making very broad statements here, right?
Very broad. Yeah, sure. Yeah.
But I don't know if the argument is that, hey, morally the founder should have given back some of that 195 million. Well, I don't know. I mean, where does that stop? And then, on the other extreme, if it's like, hey, we should start doing clawbacks on founders taking money off the table. Well, that also has a very sticky, slippery slope as well. So, But it's a good inside baseball look at like what happens when you have massive growth rates. Like, I mean, you probably know, but anybody Googling Hopin right now, during COVID, they had massive growth rates.
Yeah.
And when you have that, like, there's that old saying of like, whoever has the cash makes all the rules, or whoever has the gold makes all the rules. typically investors, when they bring the cash to the table, they're going to make the rules. The best way for a founder or founding team to like apply leverage back is to have crazy growth rates.
Yeah.
And in this case, they just, through some amount of luck and determination and timing and all that stuff, they had enough leverage to get that deal to happen. I think we would agree, by the way, that deal couldn't happen today. I would be surprised in 2024 if anybody with any sort of growth rate could negotiate a deal like that, where, you take, whatever it is, 9 digits off the table. I don't think you could do that in 2024, but you sure as heck could have done it in 2020 or 2021.
And a lot of years before that too. I think I definitely agree. I think, and these are all generalizations as well. I mean, so I looked this up while you were talking. Hopin had over 1,000 employees at their peak, and so while there is some level of lower risk for employees that come in later, if they're getting compensated in shares, whether it's restricted stock units or options or whatever, it's part of their compensation. I mean, they're making a decision to choose this over something else. And so I think, like, I am much more of a free market sort of person, so I don't think I would want regulations around this. But if I were on the cap table of this company, I'm not gonna say if I'm Brad Gerstner and I'm an altimeter, but if I'm leading this and they're talking about the founder taking that chunk of money off of the table, I'll be honest, and like, this is me, not some other fund, and maybe this is why we've never raised a fund. I would probably go back to that founder and say, look, if you want us to sign off on this deal, you're going to escrow part of that and you're going to distribute to the employees. And I don't know what the ratio should be. Again, that's like so hard to speak in generalizations. But the reality is that, if the founder peeled off what ultimately was 9 figures for their work, some of that is deferred comp to them. So, like, to say that they're not due anything is just wrong, because I'm sure that they were earning a lower salary than the CEO of a major company would have earned if they were a Fortune 500 company, or if they were a publicly traded company or whatever, which is ultimately what these companies that are raising $1 billion are trying to do. They're trying to become, massive companies. So a CEO should get paid more than they were likely getting paid. So some of it, wholeheartedly agree, should be comp for them. But the reality is like, for the ecosystem to work, the risk reward has to be balanced. And there are 3 buckets here. So there's investors, there's founders, and there's employees. And I think clearly investors our entire job is to assess the risk of a specific investment, price it accordingly, and decide if the price being offered to us is reasonable or not, and then act on that information. So, a massive part of our job is assessing risk. And then there's the next group, which is the founder. And the founder has a day job, which is to grow the company. And then they have another job, which is to manage risk, raising money for the company, deciding whether to hire people, how many shares do I give out, when do I go out to market again. So the founder has a big part in the risk versus reward matrix and making risk-based decisions. And then the third bucket are the employees. And regardless of how much they might know about restricted stock options, or any of that stuff, they are clearly the least likely to evaluate the risk. They're going to work for a company that has 1,000 plus employees. They're taking a job, and their job is to help the company grow. They're not making decisions about how the company should raise money. They're not making decisions about how the company should invest their money. And so I do think that for you to be able to attract top talent, or for this industry to be able to attract top talent, screwing all of your employees out of their stock options while you take a 9-figure check is a great way to not do that.
Okay, so I'll bite. I'll bite.
Do it.
This is going to end up being the cold open, and I'm going to get painted as the villain here. But
I love it. Thank you. I appreciate it.
Ed, I feel like you might be virtue signaling there a little bit. And let me. Okay,
you want to call me woke too?
We got a few minutes left. Let me work into that one. So look, here's the thing. I conceptually love the idea, and I've known you long enough to know you got a huge heart, and like you're coming from a good place. So I know you're not virtue signaling. So, but I had to give Jeremiah something to work with. Um, but here's the thing, like, would your so you talked about that example of like if you were in the deal, you would have gone to the founder and said, hey, if you're going to do this, if you want my blessing and my approval and all that, you're going to put this money into escrow, whatever. Would that idea change if you knew that the company had been paying above market salaries for these roles?
Sure. Yeah. No, I think that's what I say. I think that the founder is making this decision on how much they're going to pay in cash versus equity, and so they're assessing a level of risk in attracting employees. So absolutely, I think what the employees are compensated weighs into the equation. But to your point, employees that are coming in further down the path are generally speaking, not getting as much upside, if you will, because the company has matured to some degree.
Yeah, I mean, I guess like, again, I'm not, hopefully people haven't just painted me into the corner here and I'm the bad guy.
Please, everybody, paint him in the corner. He is the bad guy.
Yeah, but the thing is, though, is that like, this is, this topic of like founders being asked to distribute money to the employee base in deals like this, there are so many potential gotchas here that it doesn't work. It doesn't look good for anybody. Like, I'll give you an example. Like, let's just say you had that conversation with them and they agree. Well, what if the number you think is right doesn't match with the number that the founder thinks is right? Now you got that mess. And then let's talk about, the distribution. Let's say you do agree on a number. Well, what happens when like some portion of your employees had exercised those stock options, as an example, and others hadn't? Well, the people that exercise the risk. Now, I agree with your other point, by the way, which is, employees are the least likely to be able to assess the risk. But should employees or ex-employees that exercise their options get a higher reward than the people that didn't? I'm not going to make an opinion on that, but all I'm just trying to say is that once you get past the possible virtue signaling of what you just talked about there, again, not you in particular, but just in general, this idea
it could be
of
me.
Founder, then you run into like all of these operational risks. And here's the problem with those challenges. Like, somebody listening to this is like, oh, well, Paul doesn't like to do hard things. That's not it. Back at the beginning of the discussion of this topic, we both agreed that the most likely reason that they had to concede giving the money back is probably to get the approval of these investors to do some sort of transaction, right?
Sure.
In order for that transaction to close, you've been in enough deals like me to know that the reps and warranties are one of the hairiest parts of an exit. And if you tell me, let's just say the seller, or let's just say the founder agreed to what you just said there. Now, if I was a person in that deal alongside you, now I'm kind of like, Ed, what the hell did we do here? Like now the entire deal is at risk because the buyer wants, 24, they want to hold the proceeds of the sale for 24 months, waiting for this all to flesh out and the statute of limitations to, for lawsuits to run. So again, I'm not against the idea. It's just that when people talk about this, like even if you look at that Twitter thread that was, you scroll down that thread enough and there's all these like people like, well, they should have done this. They should have done that. I mean, there's probably a million things that they could have done or should have done or would have done or whatever. But at the end of the day, like, they had to get a deal done. And, I don't know,
they did have to get a deal done, but think about this math for a second. And I'm not going to tell you there's a right answer, because you also mentioned, you lumped in there things like ex-employees and stuff like that. To be clear, I wasn't referring to that. I think I'm referring to people that are still there actively trying to grow the company. So to be clear, like I haven't been able to exercise my options. I'm waiting for this payday. And so let's just run this math for a second. And Jeremiah, sorry, we're going long, but we got to get through a little bit more of this. So So, like, the headline is that Hopin raised $1 billion, but let's actually break the math down here for a second. The final round was $450 million. That was what they raised in the final round, right? Okay. So we know they raised that before they were at zero. And we think that the purchase price was $50 million. Let's just take those numbers at face value. And you said you thought you saw a number closer to $200 million for what the founder took out. I thought I saw a number that was around $100 million that the founder took out.
100, 200, what's the difference?
Yeah, what's the difference? It all adds up. Yeah, go
They're
check
both
your
nine
couch cushions.
figures.
You go actually check your couch cushions for the other $100 million. $100 million here, $100 million there. It all adds up, man. So let's just take those numbers and add them all up for a second. We raised 450. Okay. There's some amount of cash in the bank, and then the company sells for 50 million. So let's just say, when they raised 450 million, is it fair to say that they had 100 to 150 million in the bank at that point?
Probably. Yeah.
Yeah. Okay. So let's say 100. Okay. Is that fair?
We're just making numbers up. Yeah. That's fine.
Yeah. But we know it wasn't zero, and we know it wasn't half a million or half a billion. Yeah. So we say 100. If we say 100 million, they raised 450. They had 100 million in the bank is 550. They got 500. They got 50 for selling the company. So that's called roughly $600 million plus or minus, right? The investors got back $581 million. The founder cashed out for $100 million. Everybody else got screwed. Okay, but where are you going with this? Because I got a comment, but so none of the RSUs or options for the employees were worth crap, and anybody who was in seed or A got wiped out to zero. So I just think that proportion is not a correct proportion based on the risk that those people.
But if I'm understanding your argument correctly, which it's possible I'm not, but when you were outlining how much cash they had in the bank, I think what you're alluding to is hey, there's enough money here. Through some combination of that money and the founders, whatever the founder took off the table, I think what you're alluding to is hey, we should have done right by the employees. Is that kind of what you're saying?
Not necessarily. I'm saying if the investors were really going to take out what was the majority of the cash, it seems odd that then the founder gets everything else. And I don't know if there's another scenario here.
Doesn't that make the assumption though that all of that money was taken at the end by the founder? Money? Well, that 100 or 200 that the founder took. Not took, but that came off the table.
Even if they only took 20 or 30, think about the numbers. If the investors took 581 million back, how could this company have had a whole lot more than 600 million in the bank? I mean, the investors took almost everything, and then the founder probably took what was ever left. Like there isn't a third bucket here. The investors took back took back essentially all the cash the company had, and then maybe the $50 million purchase price got given to the founder or something.
Oh, I see. Well, we don't. Okay, so first of all, like whatever money the founder got, at least in the deals I've been in, anytime the founder takes money off the table, that transaction occurs at the closing time of the investment, right? So
yeah, and usually some of that money's held for a year or two, right?
Could be, yeah. Like so for people listening to this, like if you've got a let's say a deal closing and you're taking some of that off the table. At a high level, when that closing happens, there's two wire transfers, one for the amount that's owed into the company, and then one directly to you as part of your signature on that piece of paper as the founder. So, okay, so now you fast forward now a couple months later, and you've got, to what you're getting at. I think what you're talking about is, hey, the founder or the investors took all the money back, and then there's probably 50 million and the buyer paid for the company. I mean, look, you and I don't have any inside info, but I can probably guarantee you that the founder doesn't see a piece of that. Because that money probably was put in escrow by the buyer for a long time, a year or two, to let all the reps and warranties and potential lawsuits sort of sort themselves out. And then if and when they get distributed or those funds get distributed, they're probably entirely spoken for by the investors who've been holding that cash or holding that risk out there for a while. So I just don't think the founder is going to see any of that. I mean, it's possible, but I don't know. Like when you see these like big exits and people are like, oh, they got acquired for this dollar amount or whatever it is, people forget. And I know you don't, but like a lot of people that haven't been in these deals just don't understand that That was not some magic wire transfer. Like, Ring
Right.
Central or whoever it is didn't just blindly wire tens of millions of dollars to somebody. It probably went into an escrow,
Right.
or the majority of it did. And then it's sitting there waiting for the entire integration to happen, and that nobody, files a lawsuit against the company or claims that they're owed an extra penny on something or whatever.
Right.
And I know we're going long, but I also want to say one other thing. Like, the thing is that you're right that the employees didn't really have, most employees don't really have enough experience underwriting the risk of the stock options they might be accepting and things like that. That's a fair statement. But the other side of this is that the institutional investors that are in those deals or in that deal or in any deal, they have fiduciary duty.
Yeah.
And
100%.
if I'm an LP or a limited partner in one of those funds, and I find out that my general partner didn't do everything in their power to claw back every penny
I
that
agree.
was owed, or that's another potential lawsuit.
No, we're not disagreeing at all. All I'm saying is that maybe this is a better way to summarize it. And if we disagree on this, so be it. Like, we probably got to close because Jeremiah may slaughter us both. When Hopin gets to the finish line and has to turn the dial down, and you tell me that the founder cashed out for 9 figures after everything else that happened, which is essentially the company, exited for, 5% of what the value of raised capital was, like some horrific number. And not even their valuation, because their valuation was like 8 or 9 billion at some point. So, whatever that is, less than 1% of their valuation. The founder's not supposed to exit for 100 million there. It's like, sorry, like, however the dust settles there, something went wrong if the end story is seed and A got nothing, B, C, and D got 50 cents on the dollar back. The employees' options are all worth 0, and the founder walked away with 9 figures. That's one of those, like.
But the thing is, sorry, Jeremiah, you can murder me here, but the thing is like, you're implying that the founder just got $100 million.
No, I'm saying if the end result at the end of the day was the founder was allowed to take $100 million out along the way of what was ultimately a company that failed, something went wrong somewhere.
Well, so to be clear, okay,
or she, I don't know which it is. Yeah.
Let's just play attorney for a minute, and Rob can make fun of us later. Contracts aren't valid unless you give something in exchange for whatever you're getting. So it's not like if I signed a closing document, I mean, just, this, but just for listeners, if I signed a closing document and said, hey, I'm going to give you $100 million because I'm a nice guy, that contract's not enforceable because I didn't get any, there was no consideration. What did I get the money for?
I hear what you're saying.
So let me bite. So first of all, this 100 million that, I just sent you this article here, the 100 million that he took off the table was part of a $400 million deal that was penned in 2021. Okay.
That was when they raised the 450.
Correct. And as part of that, in that article, you can see that he sold, his consideration to get that $100 million was to sell a portion of his ownership, probably common stock or whatever the founder shares were, to those investors. So they got something for it. So let's play ball here. And just for the easy example, let's just say you talk him into giving back the 100 million. Let's just for the sake of argument, let's say you could do that. What should he get in return though? Like, he sold you something, like you as an investor, I'm using this example of as if you were in that deal, right? Just to make the point. If now years later, because of things fizzling out and all that, like, if you talk him into that.
No, it's not the fizzling out. I mean, would you agree that raising 450 million and then returning 581 million to your investors is a very unlikely outcome in our?
Oh, sure. Yeah. I mean, yeah.
So yeah. So maybe this is a better way to say it. Based on the arc of this company, and they managed to raise $500 million and return a little bit more of that to investors in what was ultimately an exercise in mental masturbation of circling this money back around and laying off a whole bunch of employees. I'm not investing in this founder if he somehow found a way to take out 9 figures while raising $500 million on something that he had to return all the cash to investors and fire everyone. Like I'm just not doing it. I understand that he did it as a legitimate transaction as part of the $450 million raise. But honestly, if you can raise $450 million for something that's valued at like 700 or 7 billion or 8 billion or whatever it is, and within 2 years, your company's worth $50 million and you're returning all this cash to investors and trying to make them half whole, you didn't earn $100 million. You just didn't.
Well, that's fair, but it assumes
you made a great deal on a great day. You had one great transaction.
Yeah. I think like your point is valid. It's fair, and that's why there's a million investors out there. Everybody's got a different risk profile. But the thing is like the vast majority of the money he took off the table was during that deal in 2021, which we both know that was like in hindsight,
the hottest of the hot.
That was like, yeah, it was crazy.
Frothy as heck.
Right. People were doing crazy things to get into deals back then.
Sure.
But look, like I would bet the follow-on investors and stuff like that didn't allow that behavior to continue on. Like the people that got squashed in those later rounds were the other earlier investors, not the later stage ones. So I don't know, like what makes this kind of hard to explain to people is that we're talking about the deal at like a discrete period of time at the end of its life cycle, right? And if you're not careful, it's easy to like look at this and say, founder took $100 million off the table, returned $500 million, and everybody else got wiped out. Like that's if that's the headline, and we're looking at it as a discrete point in time now, with that headline, okay, then people do have a right to be angry, frustrated, call people bad words, all that. But it's a little bit more nuanced than that. Like the founder.
I don't know. I'd love to see you carve out what the good headline is here. Then.
Well, I don't know. I see the reason I feel kind of strongly about this is that like the idea of going backwards in time to undo deals that happened years ago is really sketchy. That would be like, okay, sorry, we're long anyway, but here's the thing. Like, let's say you buy a car.
Obviously buying Jeremiah dinner and a hotel at the rate we're going.
Yeah, there you go. Like let's say you buy a car and the entire car company goes out of business. Like, should the car company be liable for paying you back? Should they be setting aside money to? I don't know. Maybe that's not the best example, but like.
Yeah, I don't think it's a good analogy, because here what you're talking about is saying like if the dealership went out of business, that somehow the manufacturer is liable. I mean, here all I'm saying is that I think what I'm trying to distill is that like we know that 21 was an incredibly frothy period, and we know those valuations are in many cases suspect. And so I'm sure you could certainly make arguments that maybe the people that invested in the final round didn't do enough due diligence based on, where the bubble was, all that stuff. It's just like, the way these companies burn cash. So for them to have this much money left when, when things went sideways, especially because this wasn't like, to be clear, this wasn't a company that had tons and tons of revenue. Like in the article that you cited, they got to like 70 million in ARR. Okay, well, we know that isn't all profit. So even if they had $500 million in the bank and they were making $70 million in gross revenue a year, I mean, they might not have been profitable at all. And then they spent like, $250 million to buy StreamYard at the same time, all this stuff. To me, looking at this whole thing and trying to put the pieces together, it would be very hard for me to write a check to this founder again.
That's fair. Like, yeah, I mean, if you got hurt in this deal.
No, I didn't get hurt in this deal. I'm on the outside. Like if this person came to me now and I looked through the sequencing of events, I would have a hard time. I mean, I just would. I mean, obviously I have to understand more about the StreamYard transaction, because it was $250 million. How much of that were shares in Hopin and how much of that was cash and all that? What were the liabilities and all that stuff? Like there's definitely pieces here, but I mean, gosh, I mean, look, I mean,
yeah.
go ahead.
I just think context is really important here, and neither of us has the full facts. But look, the people that move this kind of money around, to do a $400 billion deal, this is not retail investors. These are pretty sophisticated, large funds. And so I don't know, like, I get your point, though, on a personal note, like, hey, this doesn't feel right. That's fair. I totally get it. But there is another side to this coin, which is that the people that are involved in a $400 million fundraise are, by definition, sophisticated investors who did what they needed to do to get the deal done. And in this case, the founder negotiated the right price for them. And to now use that to, like, maybe cast the founder in a bad light, I think is just, that's tricky, man. It's just really tricky.
To be clear, I'm not saying that they defrauded their investors. I'm just saying that I have trouble painting a picture of a founder that that walked through these steps, because ultimately it's like I think you all know, like, oh, so this deal consummated in 2021. First off, like, I think we all kind of, like, not, I want to say kind of knew. I think some of us really knew that valuations were way overheated in 2021. But as a general rule, I think even people who weren't too close to the space knew that things were overheated. Like, you kind of sort of had to. So like for this thing to wind down this quickly afterwards, there's just so many questions. I mean, in theory, if this was, if there was some sort of acceleration here, I don't know. I keep getting stuck on. It's sort of like these pieces all can't add up. Like, you can't tell me, like, if you tell me this company ran out of money because they spent a massive amount of money on marketing and they were trying to grow ARR and they just never got there, maybe it feels more believable. And I hate to say it that way, but for this many sophisticated people to be at the table, to be pushing this money into the company, the founder's taking 9 figures out, and then, all of that money is somehow still sitting around to hand back to investors. Man, I don't know. I still walk away from this one having a very serious math problem. just a very serious math problem. And to your original point, like, you know what? It's good that the investors got a chunk of their money back. I think that I clearly, if it wasn't going to be a going concern, the founder made the right decision there. I just think I would want to double check the rest of the math.
I love like arguing this stuff with you too, because I think it's part of the reason why we do so well together is that we're not like yes people and to each other and stuff like that.
55 minutes later, it's very clear we're not yes people.
and a couple hundred episodes in.
Yeah.
So, anyway.
All right. Well, before Jeremiah absolutely kills us.
Yeah, man. All right. Well, we'll end it right there. I'd be curious if anybody else wants to pick a side on this. Just show at resultsjunkies.com. And you're either Team Ed or Team Paul, although it's unclear what either of us stand for, maybe. I don't know.
Or your Team Jeremiah, who you just feel bad because we just dropped 50 minutes of audio and video on his desk.
Yeah. I just have this mental image. At some point, I just can't have this hard idea. I just imagine poor Jeremiah sitting there in the dark listening to us, which is, I think, the weirdest thing in the world.
The best part is that when he's doing that and when we drop these sort of episodes from him, I get memes from him about like those. So just to be clear, I think the chances there's a meme in next week's episode are high. Because if we don't get more from listeners, Jeremiah will be sending me one saying, WTF with the 59-minute file, man.
Yeah, that's right. All right, Jeremiah, I'm sorry, man. Send me your Christmas list or whatever.
I got to hit the end button before we get to an hour.
All right. All right, buddy. I'm not even going to ask where you're going. I'll see you later.
Bye.